You walk into a bank, you hand them $1,000. They smile, thank you, and promise to keep it safe. Then they immediately lend 900 of it to someone else. This isn't a scam. This isn't illegal. This is literally how the entire banking system works. And the moment you understand it, you'll never look at your savings account the same way again. Let me show you something. Right now, in the United States alone, there's about $2 trillion in physical cash, notes, and coins you can hold in your hand. But if you look at the total amount of money people think they have in their bank accounts, that number is closer to 18 trillion. So where's the other 16 trillion? It doesn't exist, not in the way you think. Here's what actually happens when you deposit money at a bank. You give them $100, they say thank you. You check your account, it says $100. Everything looks normal, but the bank doesn't put your $100 in a vault with your name on it. They don't even keep most of it in the building. What they do is keep about $10 and lend out the other $90 to someone who needs a car loan. Now here's where it gets weird. That person takes the $90 and buys a car. The car dealer deposits that $90 into their bank. Their account now shows $90. The bank keeps 9, lends out 81. That person spends it. Someone else deposits it. The cycle continues. Every step, someone's account balance goes up, but no new physical money entered the system. The same $100 you deposited just got multiplied across the economy like a magic trick. Economists have a name for this. They call it fractional reserve banking. The fraction is the part the bank keeps. The reserve is what they're supposed to hold in case you want your money back. In the US, that reserve requirement used to be 10%. In 2020, the Federal Reserve dropped it to 0, which means technically banks can lend out everything. Now, you might be thinking, okay, but what's the big deal? Banks have been doing this forever. The system works, and you'd be right, mostly, until everyone wants their money back at the same time. This is called a bank run, and it's the one thing that can collapse the entire illusion in a matter of hours. Let's use a simple example. Imagine a small town bank with 100 customers. Each customer deposited $1,000. The bank's records show $100,000 in total deposits. Everyone feels secure. But in reality, the bank only has $10,000 in actual reserves. The other $90,000 has been loaned out to people buying houses, starting businesses, whatever. One day, a rumor starts. Maybe the bank made some bad loans. Maybe people just get nervous. Doesn't matter. 10 customers show up and ask for their money. No problem. The bank has $10,000. They hand it over. Word spreads. 20 more customers arrive. Now the bank has a problem. They call in some loans, sell some assets, scramble to find cash. They cover it, barely. But now 50 customers are lined up outside. The local news is there. Phones are out. Videos go viral. By the end of the day, all 100 customers want their deposits back. The bank has nothing left to give them. This isn't theory. This happened in 2023. Silicon Valley Bank collapsed in under 48 hours. Customers tried to withdraw $42 billion in a single day. The bank didn't have to. Regulators shut it down. It was the second largest bank failure in U.S. history. And here's the uncomfortable part. Your bank operates the same way. So why doesn't the whole system collapse every week? 2 reasons. First, most of the time, people don't ask for their money all at once. You deposit your paycheck, someone else takes out a mortgage. Money flows in and out, the bank stays balanced. It works as long as everyone keeps believing it works. And second, the government steps in. In the US, there's an agency called the FDIC, Federal Deposit Insurance Corporation. If your bank fails, the FDIC guarantees your deposits up to $250,000. So even if the bank runs out of money, you're covered. Probably. Here's the thing. The FDIC has about $120 billion in its insurance fund, but Americans have more than $10 trillion in insured deposits. If several major banks failed at the same time, that fund would evaporate in minutes. So what happens then? The government prints more money. They bail out the banks. They stabilize the system. Which sounds great, until you realize that printing money to cover losses just makes every dollar you already have worth a little bit less. So you get your deposit back, but bread costs more. Rent goes up. Savings lose value. The system survives, but the consequences get quietly distributed across everyone who holds currency. This is the trade-off. Banks create money out of thin air, which helps the economy grow, creates jobs, funds businesses, but it also means the money you think you have is really just a promise, a collective agreement that we'll all pretend the numbers on the screen are real. And most of the time, that's fine, until it isn't. Let's talk about what banks actually do with your money while they have it. You deposit $1,000. They keep $100. They lend out $900. But they don't lend it for free. They charge interest. Let's say 5%. Over a year, that loan generates $45 in profit for the bank. Meanwhile, your savings account pays you maybe 0.5%, $5. So the bank borrowed your money, charged someone else interest on it, and kept the $40 difference. You took all the risk of depositing your cash. They took none of the risk, and they made 8 times what you did. This is why banks have 70-story headquarters, and you have a savings account that barely keeps up with inflation. Now, in theory, this arrangement benefits everyone. The bank makes a profit, you get a safe place to store money, borrowers get access to capital. The economy grows, but there's a catch. Banks don't just lend to people buying homes or starting businesses. They also lend to each other. They invest in complex financial instruments, derivatives, mortgage-backed securities, credit default swaps, things that sound boring but can implode entire economies if they go wrong. In 2008, banks were lending money to people who couldn't pay it back, bundling those loans into complicated investments and selling them to other banks who didn't understand the risk. When borrowers started defaulting, the whole chain broke. Banks stopped trusting each other, credit froze, the global financial system nearly collapsed. Governments had to step in with trillions in bailouts. And once again, the people who caused the crisis were protected, while regular people lost jobs, homes, and savings. The system survived. But the question remains, is this really the best way to manage money? Here's the part that keeps economists up at night. The money you think you have isn't really yours. It's a liability on the bank's balance sheet. They owe it to you, but only if they can pay. If the bank goes under, your money disappears unless the government steps in. And even when the system works, it transfers wealth upward. Banks profit from lending your deposits. Executives get bonuses. Shareholders get dividends. You get a fraction of a percent in interest. There are alternatives. Some countries have experimented with higher reserve requirements, forcing banks to hold more actual cash. Some economists argue for public banking, where profits go back to citizens instead of shareholders. Some people put their money in credit unions, which operate as nonprofits. But the core system hasn't changed. Fractional reserve banking is still the foundation of modern finance, and that means your money is still part of a high wire act that only works if nobody looks down. So what do you do with this information? You can't opt out. Not really. Even if you withdrew all your cash and stuffed it under a mattress, inflation would eat it alive. The system is designed to keep your money moving, keep it in banks, keep it in the game. But you can understand the game. You can know that your deposit isn't sitting in a vault. It's out in the world, multiplying, generating profit for someone else. You can know that the stability you feel is built on collective belief, government backing, and the assumption that not everyone will panic at once. And maybe that's enough. Or maybe it's just the beginning of a much bigger question. If the money isn't real, what is?
Subscribe.